With me is Jonathan Garner, the EM and Asia equity strategist, and Chetan, Ahya, whom we are a little more familiar with. He is the co-head of global economics and the chief economist for Asia. Gentlemen, thank you very much for joining me. I can't tell you how much our viewers are going to hang on to every word that you say, because it has been this not huge, but continued outflow of foreign funds and the steady decline of the Nifty, now 11.5% lower at the lowest point of 2015. So a lot of heartburn out there after that roaring 2014 we had. Jonathan, let me start with you on that note. To what do you attribute this, mid-April onward selling that we are seeing in emerging markets to some extent as a whole, but a little accentuated in India? Is it that EM is becoming a little, has lost its sheen as an asset class?
Well, emerging markets is certainly still our least preferred area in global equities. Our top pick is actually Japan, which has been going the other direction. And I think really we wrote a note back in April about the earnings season. And unfortunately, yet again, the earnings season has turned out to be quite disappointing. And that includes in India. In terms of India's actual performance, most of the underperformance of India versus the rest of emerging markets actually took place earlier in the year, between sort of January and March. At the moment, India is holding its own relative to other EM. The EM index overall has been down 11 straight days.
Okay. To what extent should we worry about things like German bonds rising? I mean, I remember mid-April it was 0.05% on one day, or 0.07. Now, almost 85 basis points higher. And likewise, US Treasury is 1.9% mid-April, and now almost 2.4 today, perhaps 6 basis points lower. But should we worry about these bond plays? Is this the reason why we are seeing this outflow?
Well, I mentioned earnings is one of the catalysts for the poor performance, but you're certainly right. Rising bond yields and a strong US dollar has been the other catalyst. For Japan, for example, a weak yen actually helps corporate earnings, but for most of emerging markets, you get a negative dollar translation effect as the dollar strengthens, and your dollar debt servicing costs also rise. But we don't think India is as vulnerable as other parts of our coverage universe this time around. So at this conference 2 years ago, we were very worried about what the summer might bring for India, but we're hopeful this time around that India will be more insulated from these problems than other emerging markets.
Okay. But do you think that this yield hardening scenario continues for some time? So we should worry that emerging market equities as an asset class is going to be under pressure for some time?
Yes, that's right. We certainly see the US 10-year yield going higher, and we think we're only midway through a probably 5 to 7 year dollar bull run. And this is a negative feature for emerging markets overall. Now, that said, in terms of India's near-term outlook, there's a better chance that growth picks up in India than almost anywhere else that we cover in the emerging world. And there's some early signs of encouragement in that regard. And that's the reason why we're actually overweight India within this overall bad environment in emerging markets.
So you would think that if you have to give me a view for the next 12 months, it would be not terribly favorable for emerging markets, but India could outperform. Is that your...
That is our view. We've been ratcheting up our exposure to India now to quite a large overweight as the market has had a relatively poor year. That's what we like to do. We like to sort of buy low, sell high. And if our economics forecast is correct, that strategy should work quite well.
All right, I'll revisit this theme and your pecking order within emerging markets itself yet again. But let me get Chetan into this conversation. Well, we just had a credit policy which actually gave the third rate cut for 2015, or the third rate cut for the cycle, but the bond markets weren't enthused. What are your initial comments on the credit policy's takeaways?
Well, I think the bond market was not enthused for two reasons: because of what's going on in the global marketplace. Global bond yields are rising, and secondly is that the RBI gave a very hawkish inflation forecast. Now I know that there was a lot of focus in the media on the January 2016, but for March 16 it was close to 6.4%. That was definitely a big spanner in the wheel. So I think that's what I would explain the bond yield rise in India too.
Okay, but what's your own sense? Inflation gets as bad as that? Let us assume for the moment that the monsoon is mediocre, not a drought year, but not the best of monsoons.
Well, except for a drought, I struggle to find a reason why inflation will go up to 6.4.
And the governor also mentioned crude
Well, crude is unpredictable, and since RBI met, crude is only down a bit. Well, our view is that crude is not shooting up to 100. If it stays below 80, that's not going to be a big deal. Fuel directly does not have much impact on CPI, as we know. So from drivers of inflation perspective, how we have approached is two sources of drivers. One is domestic, and the second is external. And as far as the domestic drivers are concerned, the first and most important issue we've discussed, Lata, at length is rural wages. They've collapsed. They're growing at 5%. Inflation is 5%. So on a real basis, rural wages are growing at zero real rate. Similarly, the second biggest domestic source of inflation is government spending. That on a 12-month trailing is growing at, central government spending is growing at 5%, which is also on a real basis growing at zero. So the domestic sources of inflation have been killed. Then comes the issue of the external side. On the external side, it's global commodity prices. We had macro imbalances like current account deficit, so currency was volatile. That was adding to the pressures on domestic inflation. So from all the sources of inflation that I can see, I struggle to find one. Property prices, they're also now growing at probably close to at zero. So housing imputed rental cost in CPI, which is about close to 10% weighting, is also going to continue to decelerate. So if I want to really conjure up a number, I can conjure up, but you know, any rational thinking.
What is that number? Not conjure up.
We are at 4.75. We are saying inflation
for January 2016.
For March 16.
Okay.
And we are not seeing it going up above 5 in our forecast horizon, only for a short while. With some base effect, it goes to 5.1, 5.2. But largely, it's around 5 or below. I see you have to really make a bearish call on weather, and then if it is weather, how long can I assume inflation is going to be high because of weather? What happened because of unseasonal rains? Nothing happened. We have enough inventory. Domestic wheat and rice prices are actually higher than international prices. It's going to be hard to get even food inflation with some weather problems. So that's where we are.
I'm very sure that when the governor listens to this, he's going to tell you, "Aapke muh mein ghee shakkar," but that's an Indian phrase, which means I hope you are right. But I'm not
saying that they are doing the wrong thing. They have to make a rational and conservative call. But I think the market's stress out of it is, I would say, is probably a bit too much.
Unwarranted. Okay, but in any case, as Jonathan will definitely second my view, India is not bought by foreign investors or any investor because it has got balance, because it's, you know, the macroeconomic parameters are now in balance, or there is, you know, quality in other macroeconomic parameters. The only parameter why India is bought is growth. So how does that look to you?
Well, see, growth is a little complex one.
Because RBI lowered that as well.
That's right. And that, I think, is probably agreeable. See, the world is in a difficult shape. We have a very weak neighbor, which is China. And we think that that's one of the key drag on the global growth. China is about close to, in our global universe that we cover, it's about close to 20% on a PPP weighted basis. We all look at the headline number, but we have another proxy for China, what we call it as MS checks. It's available on Bloomberg, you can check it. But that's in kind of recession. So if you impute the right China numbers, the global growth is weak. And therefore, we are also seeing that in some form or the other, of course, in form of lower commodity prices and inflation, but also in form of lower export growth. Now, exports are contracting for 5 consecutive months. Together, goods plus services, exports to GDP is 24%, so we can't ignore that line item. So that's the first one. Now, as far as the earnings growth is concerned, now I'm getting a bit into Jonathan's area, but there's an element of commodity companies seeing the same impact of global commodity prices, and we see that impact in WPI inflation. It is now contracting as well. So that's showing up in total top-line growth and earnings growth. So on earnings growth, there is a complex story from the global side which is going on. Now, from a growth perspective, whether I should be concerned or not, I look at just one single parameter, which is what's happening to the capex cycle. Now, on the capex cycle, you look at CMI's capex under implementation. You look at engineering and construction companies' order book on an aggregate. Some are giving bad numbers, some are giving good numbers, particularly L&T is quite a big one. It's heavyweight on that total number. And most importantly, a transparent number, no messing around with it, is capital goods imports. That's now up for 5 consecutive months in a significantly positive territory. So capex cycle is picking up, and then the other side of the capex cycle is FDI. On a gross basis, they are up by 25%. On a net FDI basis, because of domestic entrepreneurs now not going outside, is up 90% on a year-to-date basis. So we've seen a big increase in capex. So we think that the capex story is holding up the overall growth story, and so we are not yet turning bearish on India.
So what are you working with as a number? If you're working with the old GDP series, then what would it be?
I prefer to look at old GDP series.
Sure.
And so we were at 4.5 as trough in F13.
Yes.
We are looking at 6.5 in March 16.
Okay.
So that's a meaningful, steady acceleration that we are building. And then March 17, we are at 7%.
Okay, no, that certainly looks good. And then if it is 7% in the old series, then perhaps we are at 8% in the new series. Let me come to what that means for earnings. Jonathan, you know, we were expecting this turn in the earnings. I mean, 4.5% is FY13. I'm sure FY14 also by the old series is, you know, closer to 5.5. But we have not seen the earnings cycle turn. In which quarter do you think we're going to see a meaningful jump in earnings growth?
I'd see in the next 2 to 3 quarters. In the most recent quarter, we're running at about 1% year on year. That's probably the trough. And if we get this growth pickup that Chetan was just talking about, you know, we could be looking at high teens year on year earnings growth by this time next year. And I would say that that's a better outlook for earnings than we have almost anywhere else in emerging markets. Many of our underweight countries are trapped in quite deep or severe recessions, so places like Brazil or South Africa or indeed Russia, and actually with worse currency outlooks than India has too, so that should be borne in mind. Okay,
so you would say that India could give an earnings growth this year in FY16 of over 15%?
I think it's entirely possible. And actually, if you look out to the March 2017 year end, my colleague Ridham Desai, who looks after India for us in detail here, he's about 15% above consensus. That has an effect on the forward multiple on the market. If you use consensus earnings, then India's trading about 1 year forward about 16 times. And that's actually now back in line with long-run averages. All of the kind of Modi premium in Indian equities versus the rest of emerging markets has now gone. We're back in valuation relative terms to where we were at the end of 2013. That's why we've been looking to upgrade India.